Cool. We can kick off. So thanks again, everyone, for coming. Day 3. Today we're going to go through just a quick discussion about put call parity, and what I really want to get across with this one is like how calls relate to puts, and like you can't treat them separately. And that's a big misunderstanding, I think, amongst a lot of new traders, is that like calls are different to puts somehow, and they're intrinsically related. Otherwise, through a no arbitrage argument. Then we'll get into some like popular trading strategies like call spreads, put spreads, straddles, strangles, and flies, and just give a high level overview of what those are, how to put them on, and when you might want to put them on. Cool. And again, not investment advice, just educational, all of this stuff. So put call parity, like, you might have heard this term going around with options trading, and what it really means is that like the call and the put are intrinsically related through this put call parity relationship. And so I'll try and quickly make the argument here and then show some graphs that might explain a little more what's going on. So imagine that you buy like the E3000 call and at the same time sell the E3000 put expiring in 28 days. Like, what's your payoff here on expiry? Well, if ETH is $4,000 and the call's worth 1,000, the put's worth 0, so you're up $1,000. Assuming the payoff is $1,000, doesn't really matter what you paid for them. If ETH is $2,000 and the call's worth 0 and the put's worth 1,000, so you've lost 1,000, right? And like that's pretty much exactly the same as like your payoff if you had actually just bought one ETH for 3,000. If it goes up 1,000, you make 1,000. If it goes down 1,000, you lose 1,000. Which is also equivalent to like the payoff had you long the forward. And like, don't need to worry too much about, the forward just means it's delivered in 28 days. So there's a little bit of an interest rate present value component. But essentially the payoff is the forward value minus the strike. So for no arbitrage to hold, you kind of have to have this call minus put relationship. Like the call, longing the call and selling the put has to be equivalent to trading the forward price. So you get this relationship here where the call minus the put is equal to the present value of the stock, which is the forward, minus the present value of the strike. You don't need to like this will probably take a little bit to sort of unpack and go through, but the main takeaway, I think, just for the sake of this lesson, is that this relationship exists. You can get to the call to the put, and you can get to the put from the call and to the call from the put by trading stock, essentially. So when you're buying a call, you're actually, in essence, buying a put too. And hopefully this will make a little more sense with these graphs. So imagine we have a long call position. Your payoff is pretty familiar right now. Should look something like this, where you lose some money and then you start making money once it goes past the strike. And a short stock position is just this sort of like, you lose money as the stock goes down, and you make money as the stock goes down, and you lose money as the asset price goes up. Okay, so what if you do both of these at the same time? You buy a call and at the same time you short sell the asset, or sell the asset. Well, if you combine these two payoff graphs, and sorry for the slightly janky format here, here's the short, you just have this payoff graph here. Here's the short asset and here's the long call. Now, if we start to draw like a combined payoff by like combining these lines, right? So you sort of sum these two lines everywhere on the graph. On the right-hand side, you can see that these perfectly cancel out, right? Like this is going up, this is going down, and you can sort of draw a line in the middle here, somewhere in the middle, and it just stays the same. And similarly for this, like this is, once we get to this section of the graph, this line is constant, this line is continually increasing, so we make a little bit of profit here. So sort of drawing this payoff between these two graphs, you get this, right? It's constant on the right-hand side, and then coming over here, once they cross over, you start to increase in value. Oh, sorry, I keep doing that. And what you'll notice is that this sort of highlighted payoff graph here is actually just the payoff graph of a put, which is pretty crazy. It's the same put as on the same strike and expiry as the call. So as I said, like just by selling the asset, you can get to this payoff graph of a put. So, longing a call and selling the asset, leads you to the same payoff as a put, and you can sort of do this process in reverse and get to the call. So always remember that like calls and puts are exactly the. Oh, sorry. Okay, you can't see my cursor. That's okay. Good to know. That kind of makes the explanation a little more difficult, but like just imagine that in the left-hand graph you're drawing a line, combining the two payoff graphs of the short stock and the long call, and you get this sort of on the right-hand side of the right-hand graph, you get this combined payoff graph here. Thanks for the heads up. But you can't separate calls and puts on the same strike. They're effectively the same. You can turn one into the other and back and forth just by trading the underlying asset. Cool. Now that we've sort of done that, let's get into some options trading strategies. And so the first one that you'll hear about a lot is call spreads. And a long call spread is when you buy like one or more calls with one strike and simultaneously sell the same number of calls with the same expiry at a higher strike. So you can imagine that we long the ETH 3,000, 3,500 call spread and maybe pay $200 for it. That means we buy the 3,000 call and sell the 3,500 call at the same time with the same expiry. Your max win here is the difference between the two strikes. So when ETH is above $3,500, the 3,000 strike call is fully in the money. The 3,500 strike call is also in the money, and the payoff of the net of these two calls is just $500. And so the maximum win is just the difference between the two strikes less the premium paid, and the maximum loss is the premium you pay. So $200 in this case if you're long a call spread. If you're short a call spread, it's just kind of the opposite. The cool thing about shorting call spreads as well is that your upside is your downside is capped. You're kind of making this bet that stock doesn't really go above this 3,000 range, but if you're wrong, you only lose like $500 at most, and you're selling $200 call spread. The implied odds there aren't too bad. The other reason call spreads are relatively less risky than most strategies is because your volatility is offset since you're both buying and selling calls, and so the Greeks kind of offset, and the resulting exposure from a call spread does depend on the strikes you're trading. So it's one thing to sell the ETH 3,300, 3,000, 3,500 call spread when ETH is at 3,000. You might get $200 for that, and it's not very risky in relative terms. But if you sell something like the 5,000, 6,000 call spread, that can be extremely risky because the 5,000 call isn't worth very much. So you might pay $1 for it, or $2 for it, and it could potentially go to 1,000. So it does depend a lot on which strikes you're trading, but generally with calls which are around the money or at the money, doing call spreads is a good way to sort of offset some of your risk, or at the same time enter into a long position cheaply, right? Like you can buy the 3,000, 3,500 strike call spread and pay a lot less than if you were just going to buy the 3,000 call outright. Continuing from what we were talking about yesterday, it can also be a good way to bet on skew. So like if you recall from yesterday, skew is kind of the effect that the implied volatility of an option depends on the strike. And skew tends to be lowest. Well, the implied volatility on the surface, right, usually takes like a smile or a smirk shape, which tends to be lowest in the at the money options. So you could do something like, buy the at the money call and sell the 30 delta call, which has a higher implied volatility, which might be a good way to bet on that. And as I mentioned before, you can get cheaper upside exposure by selling another call against the call you're long. Put spreads. So very similar to call spreads. Won't spend that much time on them because it's again the same sort of concept. You buy a put. Sorry, I wrote call. That's incorrect. Buy a put with strike K and sell puts with a lower strike and the same expiration K minus X. So imagine buying the ETH 3,500, 3,000 put spread for again $200. You make the most money when ETH finishes below 3,000 or at $3,000, and you have this payoff graph here. If we imagine we bought it for $200, if it finishes above 3,500, both the puts are out of the money. So the put spread is worthless. And as the price of ETH goes down, we make money all the way up to the strike we've sold, and then both calls start to have 100 delta, which means, we just sit there at 300. Like the call spread maxes out at $500, and we've made 300 if we bought it for 200. If you buy a put spread, it's bearish. You're betting on the stock to go down, or the asset to go down. And again, like call spreads, a lot of the Greeks sort of offset, and it can be a good way to sort of get bearish exposure, or sell downside without risking a blowout if the asset really tanks. So it can be a good strategy there if that's what you're looking for. Okay, straddles. Straddles is involved like longing a call and a put with the same strike and expiration. So imagine we pay $500 for the E3000 straddle. In this case, you don't really care like whether it goes up or down. What you really want if you buy a straddle is for the thing to move a lot, the asset to move a ton. And so you can see that in the graph here. Like we lose $500 if it stays at 3,000. We only break even if it goes to 2,500 or 3,500, which is a fairly big move, although it depends on the time frame. And then we start to make money outside of this range, no matter what, whether it tanks or it rips. So it's a really good way to sort of get like a exposure to the volatility, and it's typically more of a direct bet on volatility. You win when it's realized volatility is high or the implied volatility increases, and vice versa. You get smashed if the thing doesn't realize, if the asset doesn't realize much vol. So they tend to be really direct bets on vol. So you should know what you're doing and why you think volatility is cheap or rich. If you're buying or selling straddles, it can be some of the riskiest position to have. It can be one of the riskiest positions to have in options. Selling a straddle and buying a straddle too, because you're paying so much in premium a lot of the time. Strangles are similar to straddles in that like you are also long both a call and a put with the same expiry, but this time it's different strike prices and typically out of the money strikes. They also tend to be bet delta neutral. So like, because you're buying a call and a put, you're also, directionally neutral on which way the asset goes. And like straddles, you profit from higher realized volatility. It can be cheaper, but a more risky way to bet on a big move, like a straddle. You can see from the payoff graph, if we imagine we buy, pay $200 for the ETH 2,500, 3,500 strangle, we lose money, we max lose, for this entire range, 2,500 to 3,500, which is a pretty big range. We only start to make money once the put starts becoming in the money, down in this 2,500 range. And likewise, if the call starts to become in the money. Oh, these should be red. I need to fix up this graph too. The lines in the under the x-axis should be red. But the strangle, again, like you can get like cheap volatility exposure and potentially make a lot of money if you're right, because you're paying relatively little for the protection. People ask a lot about flies and butterflies, and this is another interesting strategy. It's a little more complicated and involved in terms of execution, but it's a lot less risky. Tends to be a lot less risky than straddles or strangles. It's created by buying an option with a lower strike, selling two options with a higher strike, and then buying another option back, with a higher strike than that. So, it's kind of hard to reason about just going off that, but you can look at the example here. In this example, in this payoff graph, we're buying one of these ETH calls, the 2,800 calls, selling two of the 3,000 calls, and buying one of the 3,200 calls. So it's often used as a way to like bet on a distribution. You can see from this payoff graph, like, we make a lot of money, if it finishes, around the $3,000 range. We make $200 if it pins $3,000 on expiry. And we only lose like $30 pretty much everywhere else. So it's a really good way to make a distribution bet, right? Like if you think ETH is particularly likely to finish around 3,000, you might want to put a fly on. You know, you might want to buy the fly and bet that it finishes around 3,000. Likewise, you might want to sell. Like if you think it's very unlikely ETH is around 3,500, you might want to sell a fly centered around 3,500. An interesting story, I guess. I do remember, like, if you guys remember, like when Elon Musk said he was going to take Tesla private at 420, it became this running meme with Tesla that like Tesla is going to be worth 420 or whatever. And there, I do remember seeing some flow, like, and I remember there being some chatter about like people selling the Tesla fly centered around the 420 strike price, which essentially was sort of betting that Tesla was going to pin 420 and just be worth $420, which is pretty crazy. But like that's the kind of bet you can make with flies. And again, like it just kind of shows like how flexible options can be. You really can't put these sort of bets on with most other products. The last one we'll talk about today is the Iron Condor, and this one's pretty popular, I think, with a lot of traders. You can either buy or sell Iron Condors. People tend to like Iron Condors to sort of earn yield. And what this involves is you sell an out of the money put spread and an out of the money call spread at the same time. So you're kind of betting on the asset not moving very much. So in this example here, we sell the 2,900, 2,700 put spread and sell the 3,100, 3,300 call spread. The max loss is like the difference between the strikes. And since only one of these call spreads or put spreads, one of these spreads can be in the money, our max loss is $200 if it goes sort of outside of this, outside of this range. And in this example here, we're sort of shorting this. That should be -90. I need to fix this. Sorry, guys, for all the errors in today's graphs. I need to go through and fix this, and we'll send out the updated PowerPoint after this. But this should be -$90. So when ETH is outside of this range, right, and like we sell the Iron Condor, collect $110, and ETH moves outside to our max loss, we lose $90 because we sold it for 110, and the put spread is worth 200 to the downside, and the call spread's worth 200 to the upside. But we make the most money when Ethereum doesn't really move at all, and it stays in the sort of 2,900 to 3,100 range, and we just collect our $110 and clean up on the yield. So Iron Condors tend to be a good way to sort of earn yield, and people like to do that if they don't think an asset's going to move very much, but also don't want to risk the blowout of a straddle or a strangle. Or you can buy Iron Condors for cheap exposure in sort of the inverse way. Like you can get exposure to big moves fairly cheaply because you are just trading call spreads and put spreads. So it tends to be like a favorite strategy for that as well. If you think it's going to realize a lot of vol, you would buy the Iron Condor. Cool. That's kind of it. We covered a lot of content in that session as well. If you have questions, please let me know. I'm happy to hang around again, and answer any of these questions. A lot of content there, so I'm aware of that. Mm-hmm. Yeah, definitely. I think things like structures like particularly Iron Condors are like good for sort of lower variance, lower volatility, or selling call spreads and put spreads generally is good for lower variance returns and collecting theta and things like that. and that tends to be like a fairly common structured product flow as well. So yeah, I would expect that to be something that products like Ribbon or other structured product kind of DeFi apps would be yeah, well placed to do. Um, Again, like it does vary, and like the thing is with options, like loads of people have loads of different opinions, and you can express them all very differently with a lot of these strategies. There's a huge variation. If you just look at the payoff graphs here, um, that's very different, all of them. So, I expect that like people sort of formulate around strategies that they like and just sort of stick to those. And yeah, structured products are a really good way to sort of abstract away some of the complexity here and give people access to these strategies. JVK, are there going to be any automated strategies, easy, simple mode, based on common strategies? Again, I think it just depends. I think we're working sort of, so like, it depends if there are like structured products built on top of Lyra, that will be the case. I think V1, it's going to be difficult to pull off some of these, these strategies in a capital efficient way, particularly call spreads and put spreads, as we flagged before, because we don't have the ability to pair off the collateral. So I would say that like, this is something that we are fixing in V2 and already have a fix for, are building towards. But yeah, I think it's something we'll be working towards. But it would be like an addition on top of Lyra as opposed to, within the core protocol itself. Any books / resources that you'd recommend on how to learn more about options? Yeah, it depends. I would say the Khan Academy series on options is very good on YouTube or Khan Academy itself. There is a couple textbooks. It depends how technical or mathematical you are. But Dynamic Hedging by Taleb is also very good. He kind of comes at it from like a less academic, more sort of practitioner trader kind of mindset, which I enjoy. So if you're looking for something, where he's sort of talking about options in a more accessible way than just simply going through the mathematics of Black-Scholes, then I would recommend, yeah, Dynamic Hedging. Did you want to talk about the roundtable?